Most people look at a rapidly growing company and see a sure thing. They see surging revenue, multiplying storefronts, and lines around the block. They assume momentum equals safety. But Charlie Munger looked at those exact same hypergrowth businesses and saw something else entirely. A trap. Imagine building an empire, capturing massive market share, scaling faster than anyone thought possible, only to watch every single dollar of profit evaporate into thin air because you lacked one invisible, misunderstood shield. It is the single quietest wealth killer in the corporate world. And once you see it, you will never look at a booming business the same way again. If you want to understand why empires rise and why the quietest players often own the room, hit that subscribe button right now, because what you are about to discover changes everything. Picture a crowded marketplace. Two merchants are selling the exact same essential item. Merchant 1 is growing at lightning speed. Every month a new cart opens, more people flock to the stand, and the daily sales numbers break records. On paper it looks like a triumph, but look closer. Costs are rising just as fast. Competitors are moving in right next door, slashing prices by pennies. To keep those sales booming, Merchant 1 has to spend a small fortune on advertising, constant remodeling, and endless price cuts. The business is loud, busy, and perpetually exhausted. Now look at Merchant 2. This merchant is not expanding aggressively. In fact, their sales volume has barely changed in years, yet, at the end of every single week, the lockbox is heavy with gold. When supply costs double overnight, Merchant 2 does not hesitate. They simply raise their price by $1. The customers grumble for a moment, but they pay anyway. Why? Because there is nowhere else to go. No one else has what they offer, or the friction to leave is simply too high. That quiet margin, that silent ability to dictate terms without losing a single loyal buyer, is what the legendary business partner of Warren Buffett, Charlie Munger, spent a lifetime hunting for. Most people believe that growth is the ultimate proof of a great enterprise. We are culturally conditioned to worship expansion. We clap for the startup doubling its revenue, the retailer opening hundreds of new locations, the tech platform adding millions of active users. We equate motion with progress, but business reality is often far more brutal. Growth requires fuel, and if that fuel costs more than the revenue it generates, growth becomes a cancer. Think about what actually happens when a company grows rapidly without a protective economic wall. Sales go up, yes, but capital requirements go up even faster. You need more inventory, more real estate, more human capital, more marketing, and more logistics. If your profit margins are thin because competitors can easily undercut you, every new sale actually demands more cash than it produces. You are essentially working harder, borrowing more, and running faster just to stay in the same place. Munger understood this paradox deeply. He often pointed out that a business with terrible economics will destroy your capital no matter how fast it grows. In fact, the faster a bad business grows, the quicker it drains you. Consider the difference between revenue vanity and cash sanity. Revenue is just a scoreboard indicator. It tells you how much money passed through the register. It tells you nothing about what stayed behind after the bills, taxes, maintenance, and replacement costs were paid. Companies with massive sales growth often operate in brutal commodity traps. Think of airlines, hyper-competitive software markets, or low-cost retail. Every player is offering a nearly identical service. The consumer holds all the cards. If one company tries to raise its prices to build a safer balance sheet, the customer simply clicks away or walks to the next door. This creates a race to the bottom. Companies find themselves trapped in a perpetual cycle of reinvestment. They pour billions of dollars into capital expenditures just to maintain their existing market share. They are like runners on a treadmill that keeps speeding up. If they slow down for even a second, they fall off. Munger watched decades of corporate history play out this way. He saw brilliant managers get trapped by the siren song of growth. They fell in love with the size of their enterprise rather than the quality of its economic engine. Now, flip the lens. Imagine a business that does not need to grow its top-line revenue rapidly to deliver extraordinary returns for its owners. Imagine a company that has forged a deep, unbreakable moat around its ecosystem. This moat is what we call pricing power. It is the rare, coveted ability to increase your prices significantly above the rate of inflation without triggering a mass exodus of your customer base. How does a business earn that kind of absolute freedom? It is rarely about having the lowest price. In fact, trying to win purely on price is often a confession of weakness. True pricing power comes from indispensability. It comes from creating a product, service, or brand ecosystem that is so deeply embedded in the customer's daily life, workflow, or identity that switching away feels painful, risky, or outright impossible. Think about the psychological weight of a habit or a mission-critical tool. If a business relies on a specialized piece of software or a unique component that keeps their entire operation running smoothly, saving a few dollars by switching to a cheaper alternative is a terrible gamble. The risk of operational failure far outweighs the minor savings. The vendor knows this. The customer knows this. That quiet, unspoken understanding is where true economic power lies. Munger frequently reminded investors that the single greatest ever evaluation metric for a business is the power to raise prices without losing business. If you have the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to pray for a prayer session before you raise a price by 10%, you've got a terrible business. It is a stark, uncompromising binary. There is no comfortable middle ground in the long run. This brings us to a profound realization about human behavior and business strategy. Most investors look at financial statements and read the headline numbers. They look at net income, year-over-year revenue growth rates, and expanding user metrics. They feel a rush of excitement when the numbers point upward, but they fail to look at the invisible architecture holding those numbers together. They fail to ask the hard, forensic questions. What happens to this business if a well-funded competitor enters the market tomorrow? What happens if supply chain costs double? What happens if consumer discretionary spending drops by 20%? If the business can simply pass those costs along to the consumer without blinking an eye, it possesses pricing power. If it has to absorb those costs out of its own pocket, watching its margins collapse into dust, it is living on borrowed time. Munger and his longtime partner built an empire not by chasing the newest, shiniest growth trends, but by hunting for these rare, fortress-like economic castles. They looked for businesses that required very little ongoing capital investment to keep running, yet generated reliable, surging streams of free cash flow. These were businesses where the owners could walk away for 5 years, come back, and find the enterprise stronger, more entrenched, and more profitable than before. Contrast that with the hypergrowth darling of the decade. The darling requires constant micromanagement, endless rounds of capital raising, continuous product reinvention, and constant defense against hungry rivals nipping at its heels. One model is an endless treadmill of anxiety. The other is a compounding engine of quiet, unstoppable wealth. As you start looking at the corporate landscape through this lens, the illusion begins to strip away. You start noticing which companies are merely loud and busy, and which ones are genuinely powerful. You begin to appreciate the deep psychological safety of a business that customers cannot live without, regardless of what the broader economy is doing. This is the ultimate lesson left behind by one of history's sharpest economic minds. True financial durability does not come from expanding the fastest. It comes from being irreplaceable. It comes from owning a piece of economic terrain that no competitor can invade, no matter how much capital they throw at the problem. Take a moment to let that settle in. The next time you evaluate an investment, a business model, or even your own professional strategy, stop obsessing over how fast you can grow. Instead, ask yourself a much harder, much more valuable question. What makes you impossible to replace? Drop your thoughts in the comments below, share this insight with someone who needs a new perspective on business, and subscribe for more deep dives into the psychology of wealth.